Good morning, this is Diana Sescalini, and we're going to finish Chapter 1 for Financial Accounting for Non-Business Majors. Now, previous video we talked about taxes, so now we're going to talk about Federal Reserve interest rates. So I'm going to just put myself in the corner so that you can see what I'm talking about. So the first thing we want to talk about is factors that affect interest rates. Right now, interest rates are very, very low, which is good for us. Okay, and so we're going to talk about some things. So we're going to talk about the supply of money saved is all the money that's placed into any checking accounts or anywhere you've put money away. That's called the supply of money saved. The demand for borrowed funds is all of the money that is demanded in our economy at any given time. So right now, people are borrowing money, mostly maybe to pay their bills, to pay their rent. So that's called the demand for borrowed funds. Okay, and then the supply of money saved is how much money is actually put away. So some other things, so all of these things are factors that affect our interest rates. And because of the pandemic, right now our interest rates are very, very low. And when our interest rates are low, people will buy houses, people will buy cars, people will buy things that they will have to pay over time with interest rates. But if interest rates are really low, is this really a good time to put all your money into a savings account earning very little interest? No, it's not. So other things that affect interest rates, the Federal Reserve policy. In case you don't know it, again, this is just an overview. I'm not going to make you an economic major. So the Federal Reserve is our central bank of the United States. So if you think of it like this, if your bank is Chase or Bank of America, the Federal Reserve is their bank. It is your bank's bank. That's where all the money, the Federal Reserve, where everything is generated from. When your bank needs to borrow money, they go to the Federal Reserve. And there's risk associated with borrowing money. And there's two terms here, systematic risk and unsystematic risk. Okay, systematic risk is basically anything created by an economic, political, or sociology changes. Right now, our systematic risk is very high because of the pandemic. You may have heard that credit card companies are pulling back or reducing credit limits of people who have high credit limits on their credit cards because they are afraid that they're actually going to go out and charge up because they can't afford to pay for whatever. So think of that as a systematic risk. An unsystematic risk is very unique to a firm or an industry or an individual. And I really don't have a good example of that. So just so you know, homework is not based upon terminology, but quizzes will be terminology, just so you know. So on the next slide, I want to show you this is a annual savings from 7 different sample families, okay, based upon interest rates. Obviously, the higher the interest rate, the more money you're going to save because you're going to make your best money there. So we've got these 7 people here. When interest rates are 0, nobody's putting any money in a bank or savings account. They're not making any money. So 4%. Now, actually, if you go to your bank right now and open a savings account, you're going to get less than 1%. I think I'm pretty lucky. I have a credit union that's called Schools First Credit Union. And if you put money in through direct deposit into a special account, you can get 4% a year. But at the end of the year, they move that money to your regular account. So notice that the higher the percent, the more people can actually save because it makes sense. You're going to get a bigger return on your money. So guys, the next 5 slides are charts. I'm not big on charts and graphs. I'm not going to make you draw them. I hate that myself, okay? So just so you know. So this is going to be called the supply of money. And so over here we have the money saved based upon the interest rate. And this information was taken off of the actual table, okay? Remember we talked about the demand for the supply of money and then for the money being borrowed. And we're going to look at both charts. So notice when 2% down here, there's no money saved. But when I'm at 22%, I'm saving over 12,000. I'm sorry, this is actually in, 12,000, I'm sorry, 120,000 a year. Okay, so the higher the interest rate, the more the money saved. So we're going to pick one person, and we're going to look at her demand for money. Now, the other chart we just looked at was the supply of money. So this is just for Ann Smith. So when interest rates are low, people borrow more. Okay? So notice what happens when interest rates are high, people will borrow less. And you're going to pay more interest. So this is the amount being financed. So for example, in a 5% interest rate, if you borrow $93,000, you're going to end up paying over a period of time $86,000 in interest. Okay? So you guys probably don't remember, but there was a time when interest rates were very high for houses, like 14, 18%. People bought houses, but they didn't buy them quickly because they were hesitant about buying houses that with such a high interest rate. As soon as interest rates dropped, people started refinancing to get a better interest rate, to get a lower payment to pay off their house quicker. Right now, you can buy a house at almost 2% interest rate, which is great. That means you're paying less interest. But that creates another problem, guys, because now interest on a mortgage is the only actual true tax deduction you can still take. So you want to have that to be a higher number, but then it's a two-edged sword. Okay, next slide we're going to look at is the amount of money borrowed. So this is just, so obviously when interest rates are high, the amount of money borrowed is low. When interest rates are low, the amount of money borrowed is high. And so what we're going to do is we're going to take these two charts I just showed you, this one and the amount of money saved, and put them together. And it looks like this. This is called economic. This is called supply and demand for money. Again, I'm not going to make you memorize this. Here's what we call, where they meet is called the equilibrium point. This is the supply and this is the demand line. Okay, so this is just a very brief understanding or introduction to economics and supply and demand. And just so you know, on this little next chart, and this is my last chart, this is just what we call different types of rate. These are called money rates: a discount rate, federal funds rate, T-bill or treasury bill, prime. You hear prime all the time. And again, this is kind of old. This is 2012. The prime rate is what the interest rate that banks charge their best customers. In today's world, you usually pay prime plus. So when interest rates go up, prime goes up, your interest rate on credit card bills go up. So as long as prime is low, then it helps you with yours also. This concludes chapter 1. I hope that this was informative. Let me switch back, guys, to here. I hope this was a little bit informative. It's better than just reading it and looking at it yourself. I'm trying to explain things happen. The textbook is very simple to read. It's very easy to read. It explains things very well. You will need the textbook as soon as possible. Thank you, and we'll talk to you later.